Welcome back to the channel. My name is Brad, and today we're just going to go live and talk to the community members. First of all, we'll just go ahead and remind everybody this is not financial advice or any other advice. It is Brad out on the internet sharing his life experiences with everybody that wants to listen. Don't know why you want to listen, but maybe I have some good information. Maybe I don't. But community members, we are squeezing. Yes, squeezing the income out of gold. The announcement came out today of the 10 winners of the Curve Gold Bars, and Mrs. Income Architect is already working on getting those shipped out to all the winners. So congratulations those that signed up. There was a lot of signups. And as I get more stuff like this, we will always put them out to the community just to have, a little thank you, especially, how many gold bars do I really need? I mean, really, like, how many gold bars do I really need? Anyway, squeezing a lot of money out of gold. But hey, today we're going to talk about Brad's experience of living on 8%. He's been retired now for well over a year. I mean, come on, last July, started YouTube in August. It's been a while living on 8%. First of all, I will go ahead and say this. My account today is worth more than my account when I first retired. Just how it was. It's like, wow, I actually have more money now. Glad I retired early because, what would have happened if I would have waited until I was 65, 67, then, wouldn't be able to even enjoy life. Yes, enjoy life. Second of all, before I go ahead and put up the slides for the day and talk about this, I will be going to a ETF conference down in Costa Rica just to get educated so I can come back and share my education that I learned while down there. I don't know, surfing, yoga. I mean, they're literally going to have yoga classes for us. I don't know. Can you see me doing yoga? Anyway, that is Brad being funny. So next week will be pre-recorded, and I already have a pre-recorded couple videos coming out. So hopefully you find those entertaining. But we're just going to go ahead and put up the 8% rule and talk about the 8% rule, because is this sustainable? So far, Brad's experience and my experience might be different than your experience, but Brad's experience has been very sustainable. So far, so good. The whole concept of this is that, hey, I don't have to sell shares in a down market, because theoretically we see the chart going up and to the right, but we do have downturns that we have to live through. And historically, we can see how these go, right? I mean, there's a negative downturn, of the S&P, 35.9% of the years, right? So 39% of the years, almost 40% of the years, there is a downturn. So, that's less than half the time. It depends on when you retire. You might retire and there's a downturn. So we'll see how that plays out for Brad. But so far, hey, Brad retired. The market did two huge dips. We had the yen trade back last 2024. Now, 2025, you had April come up. So he's lived through two major downturns and watched his account go down both times. I mean, it was, but every time it's always recovered. Those two dips have been buying opportunities, at least for Brad. And if you're lucky, like me so far, hey, it's up and to the right. But I'm still in my early stages. So, hey, this could really hurt me. If the market goes down significantly for 2-3 years, that really makes a huge difference, especially in retirement, right? So, somebody's already lived through. I love this one. in 2021, and he saw the downturns in 2022 and those sequence of returns risk. Yes. Now, Brad also holds 1 year in cash just in case. But we're just looking at these slides going, that's interesting that you can go through a downturn right as you retire, and it could really, really hurt your account. So the simplicity, we can get into this whole simple path. You just take 8% and sell 8%, and it becomes really just easy. Just sell shares. But it might not be that simplistic. So looking at this, we look at an 8% yield and split it into 8% of cost to the living expenses, all the surplus being reinvested into something. I don't always reinvest right back into the same funds. I haven't reinvested in QQQI in months. I've been taking 14%, stashing away that 6%, maybe even putting it into other funds to generate more income. And actually, I decreased the amount of income funds I actually had. So that's a different rule that we're going to get to. But I decreased them and actually put them back into growth and kept more growth. And I also put a little bit of growth funds actually now in my income funds, just in case there is any downturns or seeking, NAV erosion. And I've tried to eliminate some of those. And by the way, you get into this stuff, make sure that you know what you're getting into, right? Because I got into some stuff. I thought it was going to be good. I looked back at the 3-year charts and things changed in the marketplace and those weren't really good. But at the end of the day, I think I've eliminated a lot of those out of my account. And there was a lot of them to eliminate. So if you look at my original portfolio way back last year, back last August, it was slightly different than what you see today. And all the different pillars with gold and a little bit of Bitcoin, equities, business development companies, those all having that diversified portfolio has really helped through some of these downturns. So the simplistic is, hey, you invest $100,000, you just take $8,000 annual. Just poof, done, easy, simple. Just sell it. Just sell the shares. It doesn't quite always work that way, because if you sell the units as the market is going down because that's the month that you need income, well, it doesn't work out. And you can do quarterly sales as the market hits new all-time highs and have a year, maybe 2 years worth of actual cash sitting on the side, earning that 3.5–4% today. But that might actually go down too. So just keep that in mind, that actually could go down, and it could go down for a long period of time. I still say, personal opinion is 11 months, 12 months is probably going to be the most downturn that I think I will see, because I think the Fed will step in and put liquidity back to the market. But that's just Brad's personal opinion. Might want to check on that and make sure you always have stuff adjusted for risk return. So mine is, hey, I shoot for that 12% or a little bit higher, and I take that buffer. Right? If I have $100,000 and I'm making $12,000 a year, hey, I take that extra $4,000 as a buffer, put it in cash, or reinvest it into something else to try to outpace inflation. Because that's another one that's going to catch up to us over time, is inflation. And that's why we always go through these and do a mental exercise. Is this right for you or not right for you? So keep that in mind. So if I take 12%, $1,000 a month, but I'm only taking my 8%, which is 0.667 per month, that leaves me 33%. So I can put a buffer. either put it right now, I'm putting it into cash. This is December of 2025, and I am putting most of that into cash, waiting for new funds. And I will just go ahead and say this, I did take a little distribution this month. So Brad is taking distributions, so he's actually living on these and not theoretically saying, oh, I want to take this. So I took a distribution because Christmas is coming and we had to buy some Christmas presents, and we moved. And that move expense going across the country cost a lot of money. Diesel really added up this time. So let's keep that in mind. And hey, we get into this percentage protection factor of your portfolio shield. You just take that 1 minus 8 divided by your distribution rate gives you that protection factor. So what does that actually mean? If I have a 12%, I can actually have the market drop 33% before I hit my 8% on cost. That's how, mathematically, that's how it works. And that ensures that, hey, I can do a 12% pair, and I'm using something like SPY just to give you a theoretical number. And there's other funds that I got into, T-SPY, which is 14% pair. They have a farther drawdown protection that they can go down farther and you can still collect your 8% without ever having to sell any shares. And we'll just go and prelude that you need to have slightly more than what you need in a monthly distribution coming in. Now, there's more things to consider about this high yield and going up in yield and the amount of protection that actually it provides. So I used a couple different ones out there, 12, 24, 36, because 36 has to be better than 24, and 24 has to be better than 12. The problem that you get into is these actually could have a little more NAV erosion. But you think of stuff like Ethereum, Bitcoin, maybe some blocks and other funds that are out there. Well, having a little bit in them, actually have a satellite position, doesn't have to be much. Matter of fact, some of these positions are like a 0.5%, even that in my fund, right? Even K yield from Curve is a very small position, but hey, it's getting me that larger distribution, and I've reinvested some of it back in there, and I actually took some of that and invested it in other funds. So it continues to build out, but I'm actually watching my total account go up in worth. And that's a different subject for a different day, because if you're using something like Fidelity, what you see is, hey, I have NAV erosion, but you're not seeing total returns. And that is what really is important. And that came up the other day on NVII, that somebody says, hey, it's $180 and it was $180 back in August and my account's down 9%. Well, I did the math and he said he was reinvesting half of it back into it. If he was investing half of it back into it, he's actually up 9% and not down 9%. But what he's seeing is his NAV is down 9%. So a $10,000 investment would really be worth $10,900 in today's dollars at today's price. But what he didn't see was, like anything else, he is only looking at price return and not total return, which is two separate things. So get back to this. Yes, a 36% yield has to drop 77% to get to 8% on cost. So take blocks, for example. It's fairly stable. It has gone down, especially recently, but it's also started to recover. and I take a little bit of money, put it back into it, but I'm taking that rest of that distribution and putting it someplace else. And I'm also buying some Bitcoin as the market has gone down to give me more opportunity. And those funds are BITI, BTCI, and BITK. I'm doing all three funds. Which one is the best fund? That is for you to decide. But all three have done fairly well since they've been out. But go ahead and take a look at those. But on those, we also know that, hey, they could go down. But let's face it, if you're reinvesting at 3.5%, 5% below your cost basis, you should be just fine long term, because you shouldn't be able to outrun your money in 20 to 30 years, hopefully. The other one is you should always have 130% more than your income or your income projected needs. That's another little factor that you should really, really think about. Right? Really think about. And somebody just made a comment, and we'll get to that one because that's important too. So if having 130% lets you outpace inflation, and it helps your actual account grow. But anything above 130% in actual income funds actually could hurt you. And my rule is, hey, 130 to 200% of your income needs, great. Everything else just needs to be in a growth fund and let it grow over time. And just having a little extra growth out there can really help you mentally, because, hey, I can always change those growth funds over into income funds. So building this is, hey, this is just one solution. And there are many solutions. I mean, you could still go buy an annuity if you want to, but I didn't hope I would buy an annuity. I just don't see that being a prize plan. But hey, use good funds, always be disciplined, and do your due diligence, right? Because there's more than just investing. Diversification, we've talked about gold, equities, business development companies, preferred stocks, a little bit of credit. These are all diversification. Do your due diligence. Make sure that you actually know what you're getting into. Expense ratios can sneak up on you, but take my business development companies. PBDC has a very high expense ratio, but you have to know where that is coming from, because their actual management fee is only 0.75. So it's not as high as you would think. The other one is hey, I'm in a Roth and IRA. You might have a big brokerage account. And that was probably one of my mistakes, is I should have had a bigger brokerage account. But hey, you got to think about tax problems, right? You got to think about your taxes. So having something like a NEOS fund sitting inside a brokerage account might be better than something else, just because of the return of capital. Just keep that in mind. And I know everybody always asks me, what's the return of capital? Well, the fund just came out yesterday, so there's no way anybody can tell you what the return of capital is. But I get those comments every now and then. It's just like, it started yesterday and you're asking me about return of capital? Yeah, we haven't made a distribution yet. That is typical of what I see out there. So really, are you actually understanding what you're getting into? And that is always a question. Adapting to reality too. Here's another one. If you don't have to take a distribution, don't take a distribution. Just sit there and have it in cash. If it's in a brokerage account, it is cash. You can move it out. If it's in a Roth or IRA, that's why I did not go to the T72s, right? And didn't use some of those different rules, because I was going to be locked in that I had to take the distributions no matter what. And if you didn't take the distributions, the penalties were worse than paying the extra 10%. Keep that in mind, that, hey, there's multiple ways of doing this, but be, flexible. If you don't need the cash, right? I didn't need the money last month. I didn't take a distribution. I took the distribution this month. And there has been 1 month I took a bigger distribution than I ever planned, right? Just because things came up that month. I took a little additional cash because my wife had to go to Europe. So we had to take some cash out to pay for that. And that's a different story. You always got to make sure that you do cash planning for something that you don't actually plan on. That is all the slides I have for today. I'm also going to put these slides totally available to the community members. I'll put it in a post so you can download that PDF whenever you want. And we're just going to go ahead and remove it. But I saw some good questions here. If you use Fidelity's DRIP in a non-taxable account, you do 0, which really jacks up. It totally messes up your total returns because it looks like your actual cost basis is going down because it drips at 0, and it's just terrible. That is probably one of the worst things that I have seen Fidelity do. It's just bad. I do all my dripping today manually. I buy every single thing one at a time, picking. I do baskets at Fidelity. Someone like, hey, I'm going to buy my Bitcoin basket, or I'm going to buy my alternative crypto basket. And I'll just go in and I will drip back to, and it chooses according to my percentages what funds that needs to be rebalanced. That's how I've been doing it. I've been increasing it slowly but surely. But hey, that is how I've been living retirement. And so far, my retirement has been very, very good to me. I've been, like I said, almost a year and a half. And I have no other income streams besides a little bit from actual YouTube, which isn't that much, but it does help out. And I have other adventures that I'm doing. I have the Walmart store, and people know that in the community, and we'll be doing more videos about that later on. John, good morning, John. Hopefully, John stopped by the NEOS fund to check on our funds and make sure that the funds are just safe. We're just going to go through these. Single returns risk, it's a real thing. And, you know, chasing the shiny objects is something I'm actually bad at, right? I do chase shiny objects, but I've really reduced that to, hey, if I chase it, I'm only putting $500 into it to see how it works. And then I'll put a little more money into it if I'm really familiar how it works, and just build it out over time. I mean, I built out K yield, and I'm right at almost at my cost basis, and it's paying at 36%. So you sit back and say, that's doing good. I bought a little bit eggs. That's a little bit below my cost basis, but now it's become within 3.5% of my cost basis. So I'm like, okay, I'm not going to reinvest in that. So I'm just stacking more cash as I go forward. So, hey, thank you to all the community members that joined us today. And hopefully you found this educational and entertaining. And like I said, that PDF will be available in the Circle community for everybody to go ahead and have as a reference tool for later. So until next time, God bless.